All right, we're going to talk a little bit about some of the basics of job order costing. With job order costing, there are a couple of issues that you need to keep in mind. One is that the issue of cost object. Generally, one of the distinctions that's made in job order costing is the cost object is discrete, and that is you can tell one cost object from another. So, for example, if you're producing an airplane, a ship, a boat, a car, a house, often those things are considered to be independent. I can tell one from another. They may look alike, but more often than not, they will also have an identification number. So because of that, direct cost are those things that we can trace directly, economically. Indirect cost are those things that we decide that for whatever reason, they are associated with the manufacturer of the cost object, but we can't trace them economically to that. A cost pool is just simply a grouping of indirect costs. Generally because in the ledger you may have hundreds, maybe even thousands of indirect costs, and it becomes really unwieldy to work with. So often engineers and cost accountants will sit and say, okay, how can we group some of these together? We can put this 100 together, we can put this 300 together, and more importantly, we can trace it back to, or we can associate it with a particular driver or a particular activity. So a cost pool is just simply a way of grouping some of your indirect cost so that you can then divide it by some sort of activity to then allocate it to the cost object. Now, as I said, job order costing is fundamentally different than process costing. Not because of the number of units that you're making, not because process costing tends to be continuous, but this idea of discrete or distinct product, okay? And that each of these can be separated, they can be distinguished from another. Process costing, an example of that might be, for example, in the refining business, you take crude oil, you pump it into a refinery, and you produce gasoline. And what you end up with is a lot of gasoline that you can't tell one gallon of gasoline from another. So that's the distinguishing characteristic between job order costing and process costing. Can I distinguish a unit of output from another? And if I can't, then I really can't use job order costing. Now, sometimes job order costing can be associated with a batch, and that is we're going to produce 100 units of A. So the job itself can become the cost object. You can accumulate direct cost, direct labor, indirect cost in there, and then sum them up and divide it by the 100 units that you produced. Okay, for the most part, we're going to focus in on normal costing, and that is much of the chapter deals with the problem of indirect cost. Because direct cost, be it materials or labor, are by definition fairly easy to trace to the unit that you're producing. The problem is, what do we do about indirect costs? We don't really know what they are, and because they're indirect, we really don't know how much is being utilized in the production of each unit. Actual costing would be done at the end of the year when you know your actual cost. Unfortunately, for budgeting reasons and for often costing throughout the year, that's a little too late. So what companies will do is that they will budget for total overhead and then also budget for total activity, be it direct labor hours, machine hours, or direct labor dollars, and then take the budgeted overhead and divide it by that, and then come up with an allocation base. That can be referred to as normal costing, predetermined overhead rate, a normal rate. It goes by a lot of different terms. So again, just to reiterate that, the normal rate is determined by taking the budgeted total amount that you budget for at the beginning of the year, the total overhead, and then you divide it by whatever that quantity is going to be. And that becomes your predetermined overhead rate, or in this case, as I identify it, the budgeted manufacturing overhead rate. Then throughout the year, that rate is used. You're not going to change it. The assumption is it should be fairly accurate. The total amount that you budget should equal the total amount that you actually incur. As we'll see here towards the end, there may be a little bit of a difference there, but that can easily be reconciled. So when a job is complete, then you sum up the activity allocate the overhead, and then you have the total cost that's associated with that job. So the job is, in a sense, a collection of debit entries. So I could say this is job 1. So as I add manufacture or add direct materials, I'll simply make a lot of debit entries. As I add direct labor, and again, labor in manufacturing is not an expense, it is to be capitalized. So the sum of these is sometimes referred to as my prime cost, sum of direct materials and direct labor. Then, when the job is done, at that point, I add my manufacturing overhead by counting up either the number of direct labor hours, labor dollars, or machine hours, whatever that activity is, add the overhead to it. And then this then is the total cost of my job. All right, throughout the text, there are several these nice little diagrams here. So the job itself, which is the green, if you will, rectangle here, is made up of basically my overhead that I'm going to allocate to it. And the overhead is determined by taking the budgeted amount of 1.12 million divided by the budgeted amount of direct labor hours. You come up with this application rate of $40. So when the job is complete, that will be added. Direct materials are added, direct labor is added. These are referred to, again, direct cost, but also prime cost. The sum of my labor and my overhead is sometimes referred to as conversion cost. Conversion cost is a more common term that you'll hear throughout the textbook. Again, what you're trying to do is to get from the acquisition of materials, the materials inventory, and let the cost flow through to the income statement and or the balance sheet for any ending inventory. So we'll look at a series of debit and credit entries that will move the cost from inventory into work in process. The job itself is a component, a subsidiary ledger of work in process. All right, journal entries are necessary. Costs don't appear magically. The accountants actually have to determine the amount of journal entries, the number of journal entries, and the amounts that go into each account. And this is as it moves from the journal into the ledger into the balance sheet, income statement, then you have an idea of how well you're doing. You also can determine the cost. You can also determine the profit. But without the journal entries, there is no measurement of profit. So going back, just reviewing a few things. The acquisition journal entry, there'll be a debit to materials control, a credit to cash or accounts payable. Now, when materials are taken out of the inventory account, remember manufacturing is made up of 3 inventory accounts: materials, work in process, and finished goods. So as the materials flow out into the work in process, then a series of debit and credit entries are going to be made. Now, materials are taken out and they can be placed into one of 2 places. One into direct, if it's a direct material, it goes into work in process. If materials are deemed to be an indirect cost, such as paint, oil, something like that, then that debit entry will go into manufacturing overhead control. As I alluded to in class, you can think of overhead as 2 separate independent ledger accounts. Overhead control that will be a series of debit entries that measures the actual overhead. The overhead applied or overhead allocated, that will be a series of credit entries. So when a job is complete, the overhead is allocated. And hopefully at the end of the year, the 2 will equal out. And so as the materials are taken out, a credit entry is made to the materials. All right, labor is going to be the same thing. That employee that is defined as direct labor, there's going to make a debit entry to work in process or to the job. If an employee is defined as being indirect labor, then a debit entry will be made to overhead control and a credit to either wages payable, cash, or something along that line. As other overhead costs are incurred, such as depreciation, insurance, property taxes, whatever the case may be, then a debit entry is made to the actual overhead account. Usually it'll be accompanied by some sort of payable credit or a cash credit. One exception would be accumulated depreciation, so that when depreciation is not going to be expensed but rather debited to manufacturing overhead control, if it's a manufacturing cost, that is a product cost. And then the associated credit entry is going to be to accumulated depreciation. So when the job is complete, when the engineers say, hey, it's ready to be sold, that's the definition. At that point, then the overhead is allocated to it. Sum up the direct labor dollars, direct labor hours, machine hours, take it that times whatever the rate is, the predetermined overhead rate or budgeted manufacturing overhead rate, that whatever that amount is, you'll debit to work in process and credit now manufacturing allocated. There's the actual manufacturing cost and the allocated. Those are two separate. So this will constitute a series of credit entries every time a job is complete. You'll make a credit to the overhead allocated and a debit to the job. All right. So the job is done, so I credit work in process, take it out of that, and make a debit entry to finished goods, place it into that. And keep in mind, these things are going to be happening simultaneously. This is just one particular job. A factory could be handling several hundred jobs simultaneously. So all these debit and credit entries are going to be happening continuously throughout the day, throughout the week, throughout the month, through allowing costs to move over. Now, when that job, let's say it was one item, a widget was sold, then a debit will be made to cost of goods sold. Cost of goods sold is just a fancy way of saying it's an expense. Remember, manufacturing creates an asset, and I accumulate the cost in that. Once the asset I've utilized it, which in the case of inventory, I sell it, then I expense it. And then I would make an associated credit entry to finished goods because it's no longer there. Recognizing some of my non-manufacturing costs, these are going to be expenses that would be subtracted from my operating income. So again, these are not going to end up in overhead. These are simply period cost. Sales revenues, again, you guys have done this plenty of times in financial accounting, debit receivables, credit sales, to recognize the sales transaction. All right, I'll let you take a look at this particular item on the PowerPoint. What I would point out to you are two separate accounts. One, the first one here, the manufacturing overhead control, which is the actual, where you recognize the actual manufacturing cost. So whenever materials are used, labor, okay, any other associated cost, it is recognized as a debit there, never an expense. If it's manufacturing and it has nothing to do, it's not direct materials or direct labor, then by definition it's going to be an overhead. So the debit would be made there. And as we alluded to, at the conclusion of each job, a certain amount of overhead will be recognized. And sorry about that. That overhead then is allocated to the job and associating credit entry. And throughout the year, as I said, every day, every week, every month, every year, these entries are going on continuously. Okay, now overhead is the part that's a little bit more problematic in this chapter. And that is we're dealing with two different accounts, namely actual, see if I can write this out here, actual versus applied, okay, or allocated. Now remember, actual will be a series of debit entries when actual overhead costs are incurred, such as indirect materials, indirect labor, depreciation, insurance, whatever the case may be. Applied or allocated would be whenever a job is complete, a debit is made to work in process of the job, and a credit is made to applied. So these two things are happening, in a sense, independent of each other throughout the year. However, GAAP says that at the end of the year, I need to make sure that my financial statements reflect my actual overhead. So that means that any adjustment I make, I have to adjust the applied so that the applied will equal the actual amount. Because eventually I'm going to have to close these two accounts out against each other because they're nominal or income statement accounts, so they're going to be required to be closed out. So my process is a little different perhaps than what the book presents. As I talk about in class, I like to adjust the applied first, whoops, sorry about that, to make sure that it is equal by either making a debit or credit entry to adjust it so that it's equal. Then the other associated, whether it's a debit or credit, could go to cost of goods sold if it's immaterial. Now, just in terms of definitions, what this means, let's put a number in here. Make it easy. If overhead control, which represents my actual, and my overhead allocated is 10, my overhead allocated is 8, then I've underallocated, and my cost of goods sold, work in process, and finished goods are undercosted. So it means I need to add $2 to my allocated amount so that it equals that amount. So I'm going to have to credit, for example, in this case, I would credit $2 to overhead allocated and then make a debit entry to cost of goods sold. That would catch me up. So at that point, both overhead controlled and overhead allocated would be equal to 10. I can basically close them out against each other. Whoops, sorry about that. Now, let's go over here. Let's assume that this is 9, just so we'll use different numbers, and this is 11. In this particular case, it means that for whatever reason, I over-allocated. I pushed too much cost into my inventory. My work in process, finished goods, and cost of goods sold are over-costed. They're too much. So again, remember, I want this always to equal that. That's my first adjustment. So since this is sitting here as a credit balance of 11, it means I need to make a debit entry to my, if you will, my account here, overhead allocated. A $2 debit, $11 credit nets out to 9. So now they're equal. I can close them out. They'll cancel each other out. Whoops, sorry. And then by making that $2 debit entry here, I would make a $2 credit entry because I need to pull some of the cost out, okay? That is, I want everything should equal 9, and since they're overstated, I need to reduce, okay? And that would cause me then to make a credit entry to cost of goods sold, or if I'm prorating it, to finished goods and work in process as well. Now again, proration is always considered to be correct, and proration is done, number one, because it's the acceptable method, but more so number two, if you deem the difference between the allocated and the actual to be material, then I have no choice. But if I believe that the amount is immaterial, I can simply close it out against cost of goods sold, because the difference would not affect people's judgment about the company. So again, the proration is the one that's normally done. Proration would be summing the amounts in the ending balances of work in process, finished goods, cost of goods sold, find out what percentages those are, and then take the difference between the allocated and the allocated and the actual, and then take that amount times the percentages, either add it to or subtract it from those balances. And that would always be correct, or if it's material. If it's immaterial, write it off to simply the cost of goods sold. And I think we've talked enough in terms of how, when, and where you should use the different allocation schemes here. Again, job costing can be done in the service sector. In fact, accounting firms, law firms use this all the time. An audit, a tax return, a client, a trial can be used as a job. You're not producing a tangible product, but certainly you want to accumulate costs. You want to know how much it costs to do this, so that in the end you can measure profits. So a job can be something more than something that's tangible. You're not limited to a tangible good.